When wars and rumors of wars arise, how do markets respond, and what does this mean for your portfolio? Should you generally stay put, hit the eject button, and head for the sidelines? What does the experience of past wars actually suggest? Stay tuned as Roshan and Adrian discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here today with Adrian Nicholson. Erik Olson is not able to join us today. He is at a conference and was trying to record from the hotel room, but we weren't able to get the audio and video to work for him. So, Adrian, it's just you and me today.
Sounds good, Roshan. A question comes to mind. How many conferences have you been to your entire life?
Less than Erik goes to in a year.
Any good memories or any funny takes from any of the conferences you've been to, or any great advice that you've ever gotten from one of them?
Oh God, there's so many. I usually leave those things. I wish I had an answer for you. Unfortunately, I don't. But I usually end up leaving them with pages and pages of notes. Actually, this is one good piece of advice I got from someone at a conference. I wish I could give credit to who it was, but one of the speakers said that they do the same thing, take pages and pages of notes. What they would then do is just pick 3 things to actually execute on. So,
Okay, narrow it
yeah,
down. That's a good idea.
yeah, and
I think
I
that's
found that
solid.
helpful. Yeah,
A common
because
one is just networking too, just meeting all the people you possibly can at the conference.
yeah, that is definitely one that people have. I think I've done conferences wrong, and what I mean by that is I usually fly in and out, like fly in right before, leave right after, so I don't get to enjoy some of the fun stuff in the city. Like for example, I went to Park Slope, which I've heard is one of the best places to ski in the country. Our hotel was I was right at the end of the ski slope. I could see them right off my balcony, but I planned no time for that for skiing. So I think I need to do conferences a little bit better, which also I think would have given me more time as you had mentioned to network had I planned that a little bit better.
Yeah, definitely carving out some time to be able to not only enjoy the conference, but enjoy the area it's set into. I think that's big, but I'm definitely not the biggest fan of virtual conference. I don't think they really hit the same as just like the in person in a city, getting to meet people and just that face to face interaction. I think is one of the best things about them. So I'm definitely looking forward to some of them in the future. Just not only learning, but networking and just getting to explore a little bit more. I'm really looking forward to that.
I completely agree with you. I'm not a fan of the virtual conference, but I did attend a few over the last couple years. But it's so much better in person.
It's honestly just like a competition or flex to see who has like the coolest background, honestly.
On the virtual conferences. Yeah, you know what? One group tried to do something interesting. They tried to do a virtual. I can't remember what it was. I think it may have been bourbon tasting. So
Oh,
if
that's
you
cool.
signed up for it, they sent you the bottles they were tasting, and then they had their talk. Now, as I said, I consistently do conferences wrong. I decided not to attend that because it was right around 5 to 6, and I went with family dinner, bed, bath routine, keeping that normal. So I did not join that during the virtual conference. I think Erik did. We should ask him how it was.
We should. We'll ask them in our next podcast meeting, but that sounds good. And I'm ready to get into the topic today.
Yeah, I think we have a really good one that is timely with what's going on right now, but has um, uh, has further knowledge and information that can be used in the future. With the conflict going on right now, with Russia invading Ukraine and the risk of war, we wanted to look at how do markets typically react, and what can you as an investor do about it? How can you prepare yourself, and what should your expectations be? So I'll just start it off with what I thought was a pretty accurate quote that summed it up. This was this was from the New York Times article that just came out, And here's the at the very top of the article it says, uh, global markets usually weaken as wars approach, strengthen long before wars end, and treat human calamity with breathtaking indifference. And I'm starting us off with that as the article started as well, just because I think that really, in a nutshell, says it all, right? The markets weaken before. That's what's typically happened historically. Then they'll strengthen after. Big people sort of brush it off as far as the what's going on where there's this essentially risk of war. That was Jeff Summer, by the way. I wanted to give credit to the author of that line. I thought that was a great one, Jeff Summer. So that's the summary. We'll go into a little bit more in depth and some additional commentary. But Adrian, what are your thoughts? Are you seeing something similar? Seeing different things? Good summary, bad summary? Agree or disagree? Where do you stand?
I agree. I think it's a good summary. It's the whole argument of certainty and uncertainty, especially when it comes to war. It's pretty scary to think about where people's minds can really run away with the topic of war because sometimes it can be very foreign to some people when there's been not throughout history, but there's kind of been a really good time of peace. There's not large scale wars compared what it used to be, but just the aspect of is there going to be serious conflict? What kind of conflict is there going to be? The violence, the different countries getting involved, that can create a lot of uncertainty, which we know markets don't like. And then going into like the kind of next part of that summary where when things are starting to play out a little bit more, where people kind of know the direction that each like country or whatever superpower is headed in what direction, that could kind of give people a feeling what some outcomes can be. So then that's when markets can really start pricing in what might happen, and there's going to be a little bit more certainty. And I think war is just another an indicator in all this where there's so many factors that can really rock economies and markets. When you throw this other element on top of it, it could really just shake up the markets. So again, it comes down to whether it just comes down to certainty and uncertainty and just people wanting to know what's going to happen at the end. And no one can really tell what's going to happen. And at the end of the day, you just kind of have to just stick to your principles, especially when it comes to investing, trying to let behavior drive your emotions. And that's some of the themes, the concepts we're going to be touching on today.
Yeah, agreed. Markets hate uncertainty, and that's what we have. There's another article I'll reference, and we'll share all of these in the show notes. But this was in the Boston Globe by Brian McQuarrie, and I think there's a really good summary of why are people so concerned, and and what's going on, what to expect, etc. But the what the article said is what will happen in Ukraine will have reverberations as to how we're perceived and what other aggressors and authoritarians will do. I think that's what makes this a little bit different than other issues in the past. And usually in markets, the whole statement of there's something where they say if people say this time is different, it's sort of don't believe them and be careful. That's from an
Yeah.
investing perspective. That's a statement famously said around bubbles. But this is what is so interesting and different about this versus some of the other issues. Now, I still think the original quote that the markets aren't going to be really bothered by it will hold true, but there are still major differences with this versus other. Uh, there are major geopolitical impacts on this, whereas in other scenarios there aren't. A little bit more historical context is that it was called the Budapest Memorandum, signed in 1994 by the United States, Russia, the UK. They agreed to respect Ukraine's borders and political independence. In return, Ukraine gave up its nuclear arsenal. So that's another thing that makes this a little bit different is based on that, the Budapest Memorandum, we as in the United States need to go in and help. Now, I'm not an expert on the memorandum or that field itself, but my understanding is that all sides said they'd respect the borders. If they don't, the other side is supposed to defend it because the Ukraine gave up their nuclear arsenal.
Mm-hmm.
So that's another thing that makes this an interesting uh, scenario. Why the reaction is by the government, by Biden's administration, is so important as well, because there are potentially huge ramifications on it. Once again, going back to the initial statement, though, what are the markets going to do? Historically, the S&P drops about 6.5% in the 3 months following an armed conflict, and it's up about 13% 12 months after.
Yeah.
So
Mm-hmm.
what we're seeing right now is kind of in line with that.
Yeah, and that's kind of some of the data I was looking at as well, like leading up to wars. And when there's talks of wars and kind of mobilization happening, you're seeing markets respond negatively to that. And that's the uncertainty that comes then. How serious is this going to be? What are going to be the ramifications of all of this? And then the data shows after or during times of war, markets tend to have like better than when there's that implication of war about to start, where there is a little bit more clarity on what's happening. I think that's just something that's just been shown throughout history, and that's going to be really important. And what you said, is it going to be different this time? Normally, when people say that, that's normally a bad indicator. But again, that's just something people are going to be monitoring throughout. And if you want to just narrow this down a lot more, there are going to be certain industries, certain sectors that benefit from this and some that don't. One big thing too is how is this also going to affect like the supply chain issue, which is already a big issue because of the pandemic. Is it going to get worse because of that? That's something that people are going to be looking at. Also, when there comes to war, a lot of companies start winning contracts. There's also the talks of inflation, increase in revenue, which some of these things are good for the market, but some of them are bad. So looking at what areas are going to be benefiting from this and what areas aren't are something that investors are looking at to this day.
Yeah, the one thing that I'm seeing consistently is the expectation, and this makes a lot of sense as well, right? So I feel like for some people, this is like, oh, almost common sense, but sometimes you need to see it, give it some thought, let it sink in. But the one thing I'm seeing consistently that we can expect is oil prices going up, right? They've already increased, and I've seen various predictions all the way from it'll go up another $20 a barrel to predictions that it will go significantly higher than that. I don't know the answer to that, but it would just make sense that oil prices will be impacted because Russia supplies so much oil to Europe.
Mm-hmm.
So that's one where we're at over $100 a barrel, which it is the first time it's been there in about 7 years, and then if the conflict escalates, there is expected to be additional increase in prices, especially if there are sanctions as well. So that to me seems like oil prices going up makes sense just based on the supply chain. I know that's a little bit different than what you were
Mm-hmm.
referring to with the supply chain with due to the pandemic, but um, uh, one due to lack of employees to prepare the goods needed and deliver, the other being due to a conflict. But that's where it makes sense, and I'm seeing consistency around the expectation of oil prices going up.
Yeah, and just going back to that quote, like it's different this time. It kind of makes sense with this topic that we're talking about because wars throughout history are more different as technology advances, as economies and markets change. So it's always in a sense different this time because of what I just described. And I think a big thing that we just pointed out too is what countries and what are their economies like that are getting involved. That's really going to impact certain pockets of the market. So that's something that people should consider, where you can look at historical data saying like leading up to wars, markets haven't been doing good, but over time they recover. But you kind of have to look at the individual players, the individual companies, the technology and materials that are involved in all this, and see how those have changed over time and how that can impact you. I think that's a very big thing. And like you said, if you're somebody right now where your portfolio is heavily concentrated in energy, that's something that you need to be monitoring right now, because that's an area that's being affected right now.
Yeah, and it's done really well, that energy
Mm-hmm.
space. So there is for that investor, they'll be they've made money. The markets are up, but as you're saying, monitor it closely, because uh, you don't. Hopefully, this gets resolved quickly, but that could lead to a decline then in that part of the
Yeah,
portfolio.
exactly.
So
And I
yeah,
was
monitoring is
thinking
important.
about how this concept really might fit into this is the time horizon certain investors have, where if you have a very short time horizon and you're hearing talks about war and you're seeing this like uncertainty in the market, that's like something that a big consideration, something you're going to be watching. Where let's just say you have a very long time horizon, there could be I know this sounds kind of scary to say, but there could be multiple events, multiple wars throughout that can like impact you. So this is just kind of another data point or indicator that you should really watch for your portfolio. Where if you have a shorter time horizon, it kind of amplifies your kind of feelings or your emotions to it. Where we've had multiple podcasts where you got to really, at the end of the day, stick to your principles and your strategies. And you can't let that take over. What do you think about that take, Roshan?
Completely agree that the time horizon for any investment is it's so uh, crucial, right? To what the investor is looking at and doing, and to the your reaction. So if you've got a 30-year time horizon, this was just a blip on the radar.
Exactly.
On the flip side, if you need to liquidate your portfolio at the end of the year, you're probably pulling your hair out right now.
Yeah, I like that example.
So here, the thing that I found that I thought was the most interesting is, and this is just a summary of what I was seeing. The summary being, as an investor, don't necessarily worry about this conflict. And Adrian, as you said, is in particular, if you've got a long time horizon. However, um, what will this do to the Fed policy? This is what I think is really interesting. There was a great article on CNBC from yesterday, February 22nd. We're recording on the 23rd, where they talked about this, and they had said they had J.P. Morgan's chief economist quoted, but he's essentially expecting that based on this conflict, there'll be a quarter point increase in March, as opposed to anything greater than that, because there have been people talking about a half point increase, and that the Fed may have to adjust their interest rate policies based on what's going on with this Russia Ukraine conflict. That to me is very interesting, because I think that'll impact investors more,
And when
right?
what
If we
you're
look at the
saying is
historical.
this, when it comes to interest rates, the first thing that comes to my mind is bonds. So with what you said, does that mean bonds are coming back into play where they're more with interest rates, let's just say not increasing as much as they originally were going to? That could make bonds a better alternative, or what do you kind of see from this?
Not exactly, just because of what we're looking at now is, as rates go up, bond prices come down, and there may be a shorter term, like what I'd call a trading opportunity there. I'm not, as we always have to say, because we're licensed, we're not recommending anything. This isn't advice, especially in this kind of situation. This is purely almost like brainstorming. But so the short answer, I'd say to Adrian, I don't necessarily think that where I said there could be some kind of trading opportunity is there might be a short term adjustment, right? If the bond market's pricing uh, 0.5% hike, and you get a quarter point hike instead of half, there could be a trading opportunity. But the overall trend is still going to be continued increased rates, which would lead to continued bond
Mm-hmm.
declines. The other interesting point from this as far as Fed policy is, one, look to Fed policy more than looking towards this conflict to determine which way the market is headed, right? That's the first thing. Second is, let's say oil prices go up due to the conflict, as they have. Let's say they continue to rise. Well, that's going to impact inflation, which you would then think would lead to the Fed needing to raise rates. At the same time, that'll slow down growth, which to a certain degree would counter those thoughts of the Fed as far as raising rates goes. Going back to your question about bonds, as you're raising rates, bond values go down, and right now stocks are pulling back based on rates going up. So there isn't really a safe place to be as the rates will continue um, continue to go up. If you're looking at just stocks and bonds, we talked about this on previous episodes about inflation and where to go. Well, in general, if inflation's a concern, stocks are a good place to be. Real estate's a good place to be as well. We
What's
had
your take on gold?
uh, that's an interesting one. I'll say I have not personally had that for years. I find the whole gold versus crypto argument very interesting.
Can you give me?
But
I've
what
never
I've
heard the
seen,
gold versus crypto argument. Can you give a quick
okay,
summary for our listeners?
yeah. So gold, the way people look at gold is as a store of value. So if you have inflation, high inflation, you own gold because there's a limited supply. And going further beyond inflation, if you look back to when the government's printing money, gold's a good place to be because it'll maintain its value, whereas the currency value will go down. The gold versus crypto argument is saying that um, one, that argument holds true for gold. However, crypto is an even better place because just looking at Bitcoin as an example, because I know there's so many cryptos out there now, but with Bitcoin, for example, you've got a limited supply, so you can't print more, so to speak, once you go up to the maximum number of Bitcoin. Refreshing my memory, it's 21 million um, coins can be mined in total, and I think they're around 18 or 19 million right now. So the gold versus crypto argument is, what's the better store of value, gold or crypto, as an alternative for or as a place to go if you're concerned about government printing a lot more money. And we've mentioned this stat before. In 2020, 40% of all dollars ever printed were printed in that 1 year. So with that being said, your question about, is gold a good place? I believe gold is probably a pretty good place to be right now. And I'm actually going to try to look this up to see if I can find some data
Yeah, and while
on
you're
this.
looking that up, I'll just make another point where this is uncertainty and market volatility. I think this also brings up the like the concept or the opportunity of cash on hand, where you, let's just say you have that cash portion of your portfolio, you keep it there again because it doesn't move up and down, but also when there is this volatility, you can use it for different opportunities in the market. So going forward, that's just something that people should look at, different companies or whatever it may be. This could be another way where you can look at that cash portion of your portfolio, and that is just something that just kind of stays constant, but a way to deploy that where opportunities are present.
Yeah. I like what you had said about stocks. That reminds me of Warren Buffett. He's not a fan of gold because he says it lacks usefulness. So because it lacks usefulness, there's little or no value. You had also mentioned going to cash or currency, especially at a time like this, that your risk is then inflation and reduced purchasing power. But if the rate of inflation is slower than the rate of a decline in either bonds due to high interest rates or stocks for whatever reason, including increase in interest rates, it may be an option. So you've got to look at the inflation risk there. But whenever we have these conversations, I think time frame is so such an important point to look at. What is your time frame? And as Adrian, you had said towards the beginning, if your time frame is 30 years, I don't think you have much to worry about, right? However, if your time frame is the end of this year, as I said earlier, uh, pulling your hair out trying to figure out what's going to happen. So uh, the gold number I was looking for during war, I did find a quick summary which says it's the length and severity of a war that affects gold price. So rather than saying um, war causes gold price to rise, you'd want to say increased spending, government debt, money creation during times of war can lead to gold prices going up. So, not a quite exact answer. The answer is maybe it's just questioning whether it's a cause and effect piece, but gold is up roughly 5 or 6% so far this year compared to the S&P and the Dow, the S&P, the Dow, and the Nasdaq, which are all down. And gold today, let me actually, the year to date number is 5.76. Just looking at going back about a month, it's up about 3.5%. So it probably lines up with what we had seen earlier, um, or the quote we started out with saying at the beginning, the concern causes the markets to decline. It probably causes gold to increase as well. And then as things continue, markets will go up. And I think it'd be fair to say, assuming this is something short-lived, that
Mhm.
gold prices would likely pull back.
Yeah, one of the last points that's kind of come to mind is I already have my answer, but we've had an episode on this. What do you think kind of does better in a market environment where there's talks about wars or that going on? Value investors or growth investors? Or,
Oh, I don't have I always try to go back to the data on that, and I have not looked at it. Um, I would guess. Uh, I would guess
I would
value.
guess value
Uh,
too, because it seems like during uncertainty and volatility, if you have like two companies, one that's growth oriented, or you have another company, let's just say, has like a strong dividend, a good balance sheet, like cash flow, it's a very strong value company. It seems like that would do better in kind of like a stable market environment compared to, let's just say, this like high tech growth company. But again, I think it all comes down to different, there's just so many different variables into that. It's hard to do like to summarize to that point. But I think that's kind of interesting as well. What strategies do the best during certain times like these, and what strategies are out of favor is also something people should also make note of.
Yeah, my guess would be the value space because typically those companies have more stable and consistent cash flows. So they're able to come out of it. If you look at the extreme end of a growth stock, oftentimes don't have they don't have earnings,
Hmm.
and they've got revenues, and then they've got expenses, and then they're having a loss early on, and a time of war um, adds another uncertainty to when they'll reach profitability. Maybe that creates another hurdle that they're not prepared to jump over. Whereas a company with cash flow will have the ability to get through to the other
Yeah, and then
side.
I kind of answered that question earlier on. The industry or sector that the company in is definitely going to play a big role, depending on if there's war going on. I think that's also a big consideration to look at as well. So there's a lot of different points. So that's something that kind of just came to mind when I was thinking about this topic. But yeah.
Yeah, I mean, I think you're right on with that. I just picked a stock at random that would be affected, which would be Lockheed Martin, and it looks like in the last month it's up 4%, and in the so far this year it's up 9. Once again, doing better than the S&P or the Nasdaq. I'm doing the same review right now of Northrop Grumman, another defense firm, up 1.68% year to date, so not as doing um, as well as Lockheed is, and it is down 2.74. So I think that's what that shows is if you're looking at a way to try to take advantage of this kind of market, as we always say, you've got to do your homework to make sure you get um, the right position in the
Yep,
portfolio.
exactly right.
The last point I just want to mention, going back to the Fed, because as I'd said earlier, I think really the Fed is the driving force more than the conflict. And so if that's the case, then you've got to get to, well, how will the Fed react to the conflict, and how will the markets then feel about that? So one is we talked about the Fed and thinking more of a quarter point versus a half point rate hike. Excuse me. In addition to that, one thing that I found very interesting is the Fed is typically not raising rates when oil prices are moving higher. So I'd mentioned earlier the impact on inflation, oil prices going up, looking at in potentially uh, driving inflation, but it also slows growth. I wonder if that's a little bit of a guide. Now, I'm not saying they aren't going to raise rates. I think they will continue doing so, but they might slow their pace of raising rates based on the conflict, which would be another thing that would be good for the markets as well. So the impact of uh, the uncertainty, along with how that'll impact oil, leading to the Fed's decision. I think that's the answer,
Hmm.
right? As far as how it'll affect you as an investor.
Yeah, and also just another point that comes to mind is when we just talk about like the market or stocks or equities, I feel like in a situation like this, you kind of have to break it down from like domestic or international, or depending on where you may be, because that's just one of the biggest aspects of it when it comes to wars.
Very true. That's very true. Looking at those multinational firms, whether you're looking at something that's just local, which is where those smaller companies, when you talked about growth, they don't have to be small necessarily. But when I think of smaller companies uh, that are purely domestic or even purely regional,
Yeah.
are likely to be less impacted than a multinational in a situation like
Hmm.
this. Adrian, do you have anything you'd like to add?
Not at this time. What about you? Do you have any other points that you want to go over for our listeners or viewers, or final
Just
thoughts?
want to summarize. Yeah, just want to summarize in saying that the original quote we started with, I still like it, saying, and I'm going to paraphrase this time, but essentially, uh, the markets weaken as war approaches, strengthen long before the war ends, and essentially treated with indifference was where we started. Some areas that are worth looking into are the energy space and oil. Once again, not a recommendation just for investing, a recommendation for any stock ETF or anything. Not a recommendation for that at all. Just giving you ideas of areas to look at. Um, the oil space, the defense space. All those seem to be worth research, worth time to look into. And then finally, for your research time, look into what the Fed's doing and see what come to a conclusion of what you expect, and then that'll help you decide which way to go, what way you're comfortable with in your portfolio. And also, Adrian, what you had said at the beginning, which is probably the most important point, is think about your time frame, right? And that'll help guide you which way to go. Um, Erik, we missed you today. I know you're going to be listening to this when it's out. Adrian, great job, great points. For all of our listeners, please like, subscribe, give us 5 stars, tell your friends and family about us. This has been another episode of the Retirement Lifestyle Show, and we'll be back next week.